Looking at the latest news and this recent falling trend, the iShares China Large-Cap ETF, ticker symbol FXI, is throwing off some massive sell signals.
Oh, absolutely. It's a totally mixed bag right now.
Right. But at the same time, is it actually a screaming strong buy that the market is just, severely undervaluing?
That is the exact debate playing out on trading desks right now.
Yeah. So welcome to the deep dive, everyone. We are unpacking a huge stack of technical, financial, and sentiment data from mid-April 2026 to figure out if FXI is a rare bargain or just a classic value trap.
And there's a lot to unpack here, for sure.
Definitely. But real quick, just a disclaimer up front, this discussion is just a natural human debate about the data. We are not giving financial advice here.
No, strictly educational.
Exactly. And hey, make sure you like the video, subscribe to our YouTube channel, and you absolutely must leave your feedback in the comments. We really want to hear your take on this.
We do. So to give you a quick 30,000-foot view, FXI basically tracks the 50 largest Chinese stocks on the Hong Kong exchange.
The heavy hitters.
Right, the mega caps. And right now, it's caught in this massive tug-of-war between a rebound in manufacturing, which is great, and some incredibly heavy geopolitical tensions, which is, well, not so great.
It's totally pulling the fund in two different directions.
Exactly.
So before we get into analyzing, the squiggly lines on a stock chart, we need to understand the fundamental reality of what we're looking at.
Yeah, the actual numbers.
Right. And more importantly, who is actually buying it? So let's run through the financial snapshot. As of the April 14th close, the current price is sitting at $36.89.
Which is pretty interesting when you look at the 52-week range.
Yeah, that range is $32.12 on the low end, up to $42 flat on the high end, so we're hovering kind of right in the middle.
Smack in the middle, yeah. And we are talking about a major fund here. The assets under management, the AUM, is roughly $6.11 billion.
With a 0.73% expense ratio, right?
Yep. And it's throwing off a trailing dividend yield of about 2.51%.
Okay, let's unpack this, because the valuation metric is what is blowing my mind. The PE ratio is sitting right between 10.09 and 10.30.
Which is incredibly cheap.
It's wild. Buying at a 10x PE feels like finding designer clothes in a clearance bin. But, are we sure it's not damaged goods?
That's the million-dollar question.
Right. And look at the order flow. Huge liquidity, like 31 million shares trading daily. And in March, there was this massive $8.7 billion inflow into Hong Kong-listed large caps via that Hong Kong Connect program.
Yeah, the southbound money.
Exactly. So my question is, does mainland Chinese money pouring in mean the locals know something global investors don't?
Well, if we connect this to the bigger picture, you have to realize that while the PE suggests steep undervaluation relative to global peers, look at U.S. or Indian markets. Valuation alone just doesn't move markets.
Right. Something has to push it.
Exactly. Capital flow does. Which makes that mainland buying interest absolutely critical. Whether it's organic demand or state-backed funds stepping in, it provides a floor.
A liquidity net, basically.
Exactly. But fundamentals show us it's cheap and money is flowing in. The problem is the price action tells a wildly conflicting story.
Oh, man, the charts. It completely depends on your time horizon right now.
It really does.
Yeah.
Let's talk about the primary trend because it is definitively bearish.
We have to talk about the death cross.
Yeah. On March 19th, 2026, the 50-day moving average crossed below the 200-day moving average.
Which is like the ultimate algorithmic nightmare.
That's a major structural red flag for trend followers, yeah.
But then you have this weird short-term flip, because despite that long-term bear signal, the current price, the 36.89, is actually hovering just above both of those averages right now.
Right. The 50 days at 35.89 and the 200 days at 35.91.
And combined with a positive MACD flip that we saw back on March 31st, it's throwing off a short-term strong buy technical score on a lot of platforms.
Yeah, the momentum oscillators are flashing green in the short term.
Wait, so we have a death cross telling us to run away, but the short-term averages are screaming strong buy.
Pretty much.
How is a retail trader supposed to navigate that without getting chopped to pieces? That is just whiplash.
What's fascinating here is that the secondary trend is actually consolidation. The RSI, the Relative Strength Index, is completely neutral.
Where is it sitting exactly?
It's oscillating between 42.70 and 53.17. It's just holding its breath.
So it's waiting for a breakout.
Exactly. We have a strong floor of support near $36, with a deeper safety net around 35.16.
But the ceilings are heavy, right?
Very heavy. Resistance is looming right above at 37.40, and we're expecting massive selling pressure at 38.72.
So if it hits 38.72, the algorithms are just going to slam it back down.
Most likely, yeah. And the downside risk here is that if the $36 support fails, retail traders who bought the short-term flip often get trapped holding the bag.
They get their stop losses hunted.
Exactly. The floor just drops out.
Man, that is terrifying. But those conflicting technicals perfectly set up the central debate that is dominating the market right now.
The bull versus the bear case.
Here's where it gets really interesting. Let's look at the bull case first. You have this deep valuation discount compared to the US and India.
The 10x PE we talked about.
Right. And fundamentally, China's official manufacturing PMI actually rose to 50.4 in March.
Which signals expansion? The factories are turning back on.
Exactly. Furthermore, you have that mainland demand creating a solid price floor for major holdings inside the ETF, like MCHI and BYD.
The liquidity is absorbing the sellers.
Right. So that is the best case recovery scenario. But then you have the bear case, the worst case continuation lower.
And the macro environment is rough.
It really is. You have escalating U.S.-China trade tensions, and obviously we're just analyzing the macroeconomic impact of that completely neutrally.
Right. It's just a structural headwind for exports, regardless of the politics.
Exactly. And then you add in the global oil disruptions in the Strait of Hormuz.
That is a massive factor.
Yeah, because it is heavily weighing on energy-sensitive Chinese markets. And sector weakness is real. I mean, giant holdings like BYD are reporting their first profit declines in years.
So they are making stuff, but the margins are getting crushed.
Exactly. If support levels break, the technicals suggest a potential 12% drop over the next 3 months.
Which is brutal. And that volatility, when you combine an expanding PMI with declining profits, that creates the ultimate value trap scenario.
Because it looks cheap on paper.
Exactly. It looks incredibly cheap, so people buy in. But it continues to fall due to these systemic macro risks that you just outlined.
Like the energy costs and the trade tariffs.
Right. The PE is low, but if earnings keep falling, the price has to fall with it to maintain that multiple.
Which brings us to how the smart money is playing this, because with the bull and bear arguments laid out on the table, we really need to look at how analysts are actually placing their bets right now.
The ratings and signals data is super revealing here.
It is. So just recently, on April 14th, the current consensus was actually downgraded.
Right, from a buy down to a hold or accumulate.
And that was specifically due to the technical weaknesses and those margin pressures we just discussed.
They're getting defensive.
But then you look at the 12-month forecast, and it is oddly optimistic.
Very optimistic, actually.
Yeah, the average price target is $47.50.
Which is a huge jump from where we are at $36.89.
Right. That implies a massive 31% upside potential, and the high target is all the way up at $55.70.
Even the lowest bear case target they have is $38.82, which is still above current levels.
Exactly. But the short-term outlook is just neutral to slightly bullish. They expect it to bounce in this incredibly tight interval between $36.59 and $37.19 in the coming days.
They're just projecting a sideways chop.
Yeah. And then the long-term outlook still says bearish indicators persist due to the macro risks, even though the low PE suggests undeniable long-term value.
Market sentiment is definitely cautious. The roaring rally we saw back in 2025 has completely cooled off.
So what does this all mean? I mean, I have to ask you, how can analysts downgrade the ETF to a hold while simultaneously predicting a 31% upside?
It seems totally counterintuitive.
Right. Isn't a 31% gain a textbook buy?
This raises an important question about risk-adjusted returns. Analysts aren't just looking at the potential upside. They are looking at the probability of surviving the volatility to actually get there.
Surviving the chop.
Exactly. They're waiting for confirmation before committing fresh capital.
What kind of confirmation?
They want to see a clear, undeniable breakout above that $38 resistance ceiling.
Because that would invalidate the death cross.
Exactly. Or, on the flip side, they want to see a retest of the 32.12 annual low so they can buy the absolute bottom.
So they don't want to get caught in the middle.
No, the middle is where retail traders get chopped up. Institutions would rather sit in a hold, eat the opportunity cost, and wait for a clear signal.
Wow, that makes a lot of sense. So to briefly recap here, there is just incredible tension in FXI right now.
A literal pressure cooker.
Yeah. You have mainland buyers pouring billions into deeply discounted stocks, creating this floor. But long-term technicals are flashing heavy warning signs and massive resistance looms right above the current price.
It's a standoff between domestic liquidity and global macro reality.
It really is. So I want to leave you, the listener, with a final provocative thought to explore on your own.
Oh, this is a good one.
We know the technical floors and ceilings of the ETF as a whole, but what are the specific companies inside this wrapper doing to drive these levels?
Because an ETF is just a basket.
Right. If you looked under the hood at top holdings like Tencent and Alibaba, would they show the same mixed signals? Or is one giant holding secretly dragging down the rest of the healthy companies?
When you buy an index, you buy the weakest link. In markets like this, patience and critical thinking are your absolute best assets. Do the homework on the individual allocations.
Couldn't agree more. All right, that is all for today's deep dive. One final reminder to like, subscribe, and drop your theories in the YouTube comments. Is FXI a value trap or a generational buy? Let us know. Thanks for joining us, and we'll see you next time.